Welcome to the Gray Report. I'm your host, Spencer Gray. I'm joined once again by Jay Reeder, the Chief Investment Officer at Gray Capital. So if you're a passive investor, active investor, maybe you are somebody that's been working in the industry, you're going to kind of want to stick around to watch this entire episode. Because we're going to be, for lack of a better term, picking Jay's brain, seeing what's going on in the acquisition space, the asset management space. Jay is actively working multifamily deals, has tons of experience, a variety of different strategies, working for different firms, everything from student housing, affordable housing, market rate housing. He's had his hands on a lot in the industry. So Jay's a wealth of knowledge. We've got some new reports that are out. It's a Matrix Tuesday here at Gray Capital. We got the Yardi Matrix. Arbor has their own kind of Matrix report. And in this Arbor report, it's exciting. They've listed Indianapolis as the top investment market for the first quarter of 2026. Obviously, we talk about Indy here all the time because that's where we're based out of here at the Gray Capital corporate headquarters in downtown Indianapolis. So we'll be jumping into that. Yardi has a new report. We might touch a little bit on what's going on, geopolitics with this whole war, not war blockade in Iran. And again, it's not that we really want to talk about it. But it does impact our business in multifamily, especially if you're trying to operate or maybe close a deal this year, maybe lock in some debt. But when oil is, it could be $100-ish, maybe today, it could go to 120, maybe 150, maybe it goes to 85. There's a lot of implications for our business, not just if you're buying a deal, but for everybody in the economy. So that's going to be top of mind. Stick around for the whole episode. If you haven't subscribe to the Gray Capital YouTube channel, though, this is your sign to do so. That way you get updates, information. If you press the bell icon, it'll actually force a notification over to your screen, which is really helpful. All right, let's jump right into the report. Welcome back to the Gray Report. Jay, thanks for coming on. It's great to see you.
Glad to be here.
Even though we see each other most days. But it's great to see you in the podcast room. Griffin Haddad, he's on assignment. He's down in Palm Beach. He's at an investor conference. He's talking to LPs, other sponsors, seeing what's on the ground. So next week, he'll be back, have a report for us. But how's your week going?
You know what? Getting a taste of everything this week on the acquisition side, on the asset management side. So I feel like I'm sharp in all areas right now.
Yeah. This business, especially we Gray Capital, Gray Residential. It's not like we have 1,000 employees and we have this massive sprawling organization to where you're so siloed, Jay, that you don't get to. There are certainly things that parts of the areas of the business that you're not as involved in, but when you're overseeing acquisitions, investments, and also kind of asset management. So it's the properties themselves. That's a lot of different hands in different places and a lot of things going on.
Yeah. And even if my hands aren't necessarily like in working on each of those things, I see it because of how it affects all the other things I have to do with. So I feel like I'm constantly being pinged and let know what's going on. Some of the things I can do stuff about, others I can't, but
you're in the loop. So, I don't know if I've asked you this on the show. Maybe I did couple of years ago. Obviously, Jay, you were on the first episode of the Gray Report when the first time we did this, when it went from let's just talk about what's in the newsletter, which again, we've got the best newsletter in the multifamily industry. Go to graycapitalllc.com/newsletter. But you were on the first episode. It's probably like 2 hours. We were just talking about every article, just letting it go. Didn't think anyone was going to watch it. And now we've got, I don't know how many, 15,000 subscribers or something and 200 plus episodes later. But for those of the folks that are watching that aren't as familiar with you, what do you do here at Gray Capital?
So I'm our Chief Investment Officer. I came on board about 6 years ago with Spencer, just kind of trying to launch Gray Capital off the ground. You had kind of taken the legacy portfolio of investments that you've worked on, and we're kind of trying to bring in some in-house asset management and kind of force the growth of the portfolio itself. So it brought me on to help with that. 2020 was a really fun year.
We should, I forget if we talked about this in a previous episode, forgive us. Maybe we should kind of go back and kind of tell this story. Because I bet a lot of people listening haven't heard it. tell the story from your perspective, and I can chime in also. But go back. It would have been what? It would have been in 2019, in was like October 2019 or so.
So we started talking October 2019, and it's kind of funny. I worked for a great company, company I have a lot of respect for, and it was funny. I had just actually gotten a promotion at the company, but the way the company kind of operated, like I was kind of told I was getting a promotion, but that promotion wouldn't go into effect until beginning of the year. And so when that kind of happened, I was like, okay, like here's the offer they gave me, but I was like, okay, I'm just kind of curious, like, is that market, like kind of what I was offered? And you had a posting online for an asset manager position. I was like, this is perfect. It's apples to apples of exactly kind of what I'm doing. So got talking to you just to kind of understand. I wasn't really interested in moving, but just understanding kind of like what the market was. And I remember talking to you. You were at a conference out in San Diego, and I was sitting. I went to like a parking lot about a block away from our office and sat in the car and had a conversation with you. And I was like, oh, that's really interesting. I'm interested in doing this. And so think about a month later, you were back in town. We went and grabbed lunch over at North End Barbecue.
Yeah, rest in peace.
May it rest in peace. And I was really interested in kind of things we said, but like I said, it was, I think in November about that time period, and we were kind of coming up on end of year. And at that time, I still wasn't really looking to make a move, but I was just kind of interested in understanding kind of more because I'd been in multifamily. I had a lot of experience, but that wasn't originally what I thought I was going to do as a career. And so just kind of understanding what was out there versus what I had already been doing. And then time passed, holidays happened, and I think you reached back out to me kind of middle of January. Mm-hmm. And just wanted to kind of get the conversation going again. So we started talking, and then I remember you offered me the job. God, I think it was like...
Can I ask you just want to stop there? So we had the first interview, well, obviously the phone interview, and then we got together at North End Barbecue, and then a little bit of time went by, and because I was having a conversation with somebody else, and that conversation didn't work out. And then you were the next person I wanted to call. And I remember, funny because the first interview at North End Bar, I think you're wearing a suit. You were like ready to go. Yeah. You were dressed for success. You're ready. And then the second time, I was like, let's get back together again. Let's keep talking about this. And it was interesting because it was like almost, I felt like you weren't dressed in a suit that time. You were like on your way to work, kind of just wearing like like you're just normal like work clothes or whatever. And it was much more of like, yeah, I'm interested if there's something available, but like kind of take it or leave it. And you were curious, but also like, it's not like we were a large established company. It was just like me and Alex. And I think there was a lot of kind of unknowns.
The biggest thing on that one was I remember kind of at that time, I was talking to my wife, Kelsey, and she had said something to me. She's like, you've been doing this interview. She's like, is it real? And I just like, I don't know. Because like I said, it was around the holidays. And so like, it wasn't like, oh, the fact that I didn't get a call this week, it registered just because like, there's not a lot going on that time of year. And so I was like, I don't know. And she's like, well, you have a good thing. Like, if it's not real,
that's fine.
Like, don't screw up the good thing that you have.
Yeah.
And so when we met again, and I think part of it too, I think was I was on my way to work, and like we had a more casual dress code.
Yeah.
And so I didn't want to set off any red flags that I was coming in a little bit nicer. But I was definitely interested, but that was right around the time because then I had officially become an asset manager. Like I wasn't kind of in that, I'm not yet. So I had officially become an asset manager. And then you had offered me that job. And I remember it was right around February because I accepted the job on Valentine's Day. I remember that. It was Friday. It was Valentine's Day. And you had let me sit on it for about a week, and I wasn't sure like what I was gonna do. And I had a couple calls with someone. Actually, one of the people I called was Mike Dury.
Yeah.
And I was just like, is this real? And that's kind of the point you had. I was like, is it real? I was like, because this seems like an awesome opportunity. It's taking a risk, but I wanted to know, is it real? And Mike was real upfront with me. He's like, it's real. He's like, but you're gonna get out of it what you put into it. He's like, you're gonna be walking into where you were previously, where you have all of these systems and everything. And he's like, you're going to have to put in the work, but he's like, if you put in the work, it's real.
Yeah. Yeah, well, good framing from Dury, because that is exactly what happened, and so you did accept the job, which I didn't think you were going to do, because here's the thing. So like at that point, Gray Capital, we were not doing our own lead sponsored deals, so we were partnering with other operators as co-GPs, and so we were providing, call it 10 to 20% of like the equity needed, getting major decision controls, providing a loan guarantee, like doing asset management work, but they were doing the heavy lifting. And that was great from my position, because like it was like high leverage in terms of like I'm putting in this effort and then I'm taking advantage of all of their systems and their technology and their deal flow. And so like I could keep very streamlined. Yeah. But as the portfolio was growing, and this is the original impetus for doing this, the portfolio is growing. I'm like, well, I need to be better equipped to manage the portfolio, and I don't know what I don't know, and what could we be missing, and like if we could move the needle just on one asset, make one recommendation, find one piece, and if we can find some gain, put a cap rate underneath that, then all of a sudden, we can justify a salary pretty quickly, and just like not missing something that we don't know to even look for. But I remember in probably the first or second interview, and I had other people tell me this, is that, is there enough work? Because, well, that is what we had been doing. I wanted to start doing our own deals. And so like there was like two jobs, or kind of two aspects of the job. One, helping to manage the existing, legacy portfolio. And then there's we're going to go build our own portfolio. And with a different model, we're going to go do our own deals. And I think that just a lot of people, and I mean, you obviously took the job. You believed in it enough to take that leap, because, just managing the legacy portfolio, like, yeah, like there is value there, but the real value is actually going out and doing more deals. Yeah. And, yeah, not a lot of people thought we would actually do that, or they didn't think that I was going to do that. They were like, again, the co-GP model was working really well. We were able to scale really quickly. And there's an argument, it's like, just keep doing that. It's really efficient to do that. There's reasons not to. You just, again, need to start raising more money. And if you're raising all the money, it was more of like, once I really understand the business so well, I'm like, why don't we just do this ourselves? Like, I understand it. I understand all the steps. And I think there's ways that we could do it a little bit different, a little bit better. But I didn't know what I didn't know, and didn't want to make any very expensive mistakes. And bringing somebody on the team was I thought, going to be a lot cheaper in the long run, from not making expensive mistakes, but also maybe getting the revenue ramped up quicker. Because if we could actually go buy a deal with credibility and confidence, obviously that's a major driver for the business. So you said yes. What was the reason? What made you say yes? And then walk us through the first week.
So what got me to say yes? I was leaning saying yes. And the company I was at before, it was actually that Friday that I was going to make a decision, because I had told my boss, like my old boss is my mentor. I still talk to him to this day. You've met him, you know him very well. I would argue, like, you are very complimentary of me. I would be nowhere near where I am without him, and I am still not what he is. I would say he's one of the best in the industry, bar none. And so because he meant so much to me in that relationship, I was upfront with him that I had been offered that job. And so he took it, and I was like, I haven't made a decision. I don't know yet. So he actually talked with the president of the company, and just like, hey, he's like, I don't know what this is, but he's like, I'm just letting you know that Jay has this offer on the table. And knowing how some companies operate, it was like, I didn't know if they were going to try to offer me something to stay. I didn't really want that, but like, I just didn't know. And I was like, you can tell him, like, I've told you through this whole process, I want to be an open book. Like, I'm not trying to hide anything from you. And the president called me into his office that Friday morning. And he's like, hey, I'm not going to like give you some big, he's like, you know how we operate. He's like, you've done well here. He's like, all that. He's like, I'm not going to put some big thing in front of you to try to get you to stay. But he's like, if you're leaving because you don't think there's a path for you here, he's like, I want to assure you that that's not the case. He's like, it's not going to be tomorrow. It's not going to be today. But he's like, I never would want to lose a good person because you don't think there's a path for you. But do what I remember him vividly saying, he's like, I will never fault you for making what's best decision for you and your family. And I remember leaving that meeting and I was like, man, he just made this so much harder. Because that day I had
kind of permission, but also like,
but I like it made it harder to walk away because I knew I was leaving like some people that I respected a lot.
Yeah.
But when he said, are you doing this for you and your family? And I knew I was doing it for me and my family to kind of do other opportunities that I wouldn't have in that role. That was where I was like, I know the decision I need to make. And so as soon as I got out of that meeting, I called my wife and I was like, okay, I'm going to take the job. And so I remember calling you again. I went to the parking garage, sat in the car, gave you a call and was like, when do you want me to start?
Yeah. I was surprised. Again, because at this time, Alex and I'm like, all right, this is happening. He said yes. He's made a decision. I assume he may have told someone else. And I'm like, oh, we got to pay this person. Like we got to figure this out. And so it became real. And I don't think that if you hadn't said yes, who can't predict the future, what would have happened. But given what was getting ready to happen with COVID, I don't think that we probably would have gotten started. Certainly not the way that we would have, and certainly wouldn't have been able to do the deals that we.
Yeah, and then I mean, obviously, probably the next phase of the story then is obviously the week I started was the week kind of COVID shut down the country, and I remember like my going away lunch at my previous company. I remember it was like one of the first like. I can't remember if it was nationally or if it was Indiana or what it was. And I remember everyone kind of joking, oh, better go wash our hands before we eat lunch. And I like, lo and behold, a week later, our lives all changed.
Yeah. Wow. I mean, I remember first day we drove around a little bit. I think, we drove by 2 West.
So we drove by 2 West and then we drove a bunch of comps up in Carmel for 2 West.
That's right. And then I remember coming back, and so we were like working out of an office out of my dad's house at the time, and essentially it was like my old bedroom. And you started working on the model. You're like, right, and I think you took Mike's word to heart of like, you're going to get put out of it. You're going to get out of it what you put into it. And I think you may have spoiled me a little bit because, you just like kind of got to work and were like, this is like to do my job. I'm going to have to build out this model. Let's start working there. Let's get to it. Whereas, which was great because even now, especially not then, like not always, certainly was not great at being, all right, here's your task list. I'm going to delegate you these items. It was more of like, hey, here's the general goal. That's what we're trying to do. And you're like, all right, sounds good. We're going to go and buy deals. First thing is I need to really work on a model, building our own model. And so you jumped right to work, and that maybe took, I don't know, I think that by the first day you had like a pretty good framework.
Yeah, so the first day was a lot of driving around, getting it, and then kind of that second like working day, it was, I don't know if I had it completely done, but we had a good kind of benchmark of what we wanted. And then that kind of third day was, we were working on that, but that was the day the stock market crashed.
Yeah, stock market crashed, and the 10-year, dropped to, below 1%. And I still have a screenshot on my phone of the 10-year at like 0.5%, 50 basis points or whatever. And then, they canceled the NBA season or something. Yeah. Tom Hanks was sick. And so, but we'll fast forward. We won't tell the whole story of our lives, but, it began in this time of uncertainty, and Jay had just taken this massive risk for his own career and his family's livelihood. And then the world starts crumbling down. And, I'm sitting there being like, feeling not just responsible for, Alex and I and my family and what we want to do and what we want to do with the business, but all of a sudden it's like we've got this other person that's also on the team that just take a massive risk, or at least a leap of faith, and believed in whatever we were doing enough without really knowing us enough, and being like, well, I have this great responsibility to you and your family also. We got to figure this thing out. And we ended up doing 3 deals.
We did
in 2020, which is wild to think about, doing 3 deals in 2020 when now all we want to do is at least 3 deals, and like the market is messed up. We're going to talk about the market. Things were more messed up in COVID though. It's wild. I don't know. I mean, obviously pricing is different. we've learned this over time, though, is that we tend to buy deals and find success. We find opportunities when there is some sort of market uncertainty or disruption. And I don't think it's like us blindly running in when everyone's running away. Or if we're just trying to see past it and see, the bigger picture maybe, or maybe it's like, hey, we want to do this. We're setting out to do it. I don't think that we're blind, but whether it's then or if it was, in during 2022 when rates started rising and we had to renegotiate deals, but we stayed in the market. We've stayed in the market pretty consistently.
We've closed a deal every year.
We've closed the deal every year. We haven't.
2023 was maybe cheating a little bit because that was a deal we got in 22 and closed in February of 23.
Yeah.
But to be technical, we have closed a deal every year.
Yeah. But it was not easy to do. But yeah. So what's changed the most from when we started to today? And you can take it from any angle, whether it's doing deals or just what's different.
I mean, doing deals is obviously different because I think we operate in maybe a little bit different kind of class of property than we did when we started. And so the competition, maybe there's not more competition or less competition, but the competition's different. So we have to think about it a little bit differently. I mean, the first two deals we did were $8 and $10 million, roughly $2 million equity raises.
Yeah.
Those can be competitive and there can be a lot of people bidding on those types of deals, but it's just different. There are some people who can just kind of insert themselves in markets like that. Mm-hmm. Yeah. And I think we were in a position to do that at the time. We are one of many and are probably in some cases a small fish in other things that we go after right now.
Yeah.
But I do think that we have a strong eye.
We're a medium-sized fish.
Medium
in our smaller, medium-sized ponds of the Midwest.
I guess I was thinking nationally, but yes,
nationally.
In the nationally. Nationally, we're small. I would say Midwest. We have a good reputation. We have the connections that we need to. We know the markets that we're in. But we're going up against those national people in markets we look at because, like we see in some of these reports, the markets that we operate in are some of the more desirable markets. And I think at the time, I remember you saying like, "Hey, when we were first in the Gray Report, like Indianapolis, we're just steady Eddie. We're never going to be highs. We're never going to be lows. We're just going to kind of be there." And the investment and the competition at the time kind of showed that. I still think that's the case, but when you're going up against areas that are seeing high highs and low lows, when those are in the low lows, those steady Eddie markets are all of a sudden the highs. And so I think that's kind of what we're seeing in the market right now is that we're not doing much different than we've ever done in the market, but it's viewed nationally differently.
Yeah.
And the competition a little bit differently. But honestly, I think the thing that's changed the most, and I hate to say the mo money, mo problems, but like we're bigger. And when we're bigger, there is just more people.
We get sued more and more people quit and we have to hire more people and all of that.
Yeah. And so before it was like, hey, Jay, come in, buy me a deal. And it's like, as long as I'm buying a deal, like we're good. And now
so it was simple. It was simple.
But now that we have a portfolio, like there's stuff we have to do to manage the portfolio and protect investor capital on that. But part of that is dealing with either our internal property management on deals or like the one deal that we do that is third party and like managing those people. And then especially on third party, like we don't handle their employees necessarily. And so like if I have a problem, it's like all the people I have to deal with to get a problem resolved.
Yeah.
And so I think that's probably the market obviously changes and that's always going to change. But I think from a company standpoint, I think what has changed the most is like, as we've gotten bigger, like my roles are technically still the same, but because we've gotten bigger, the exponential complexity underneath each of those roles has grown and changed significantly.
Yeah. No, that it is always changing and evolving and it just gets more complex. Again, because what I'm doing isn't really any different. It's just there's a lot of complexities underneath it, and we have a lot of other people that are kind of working with us and under us, for us, whatever, and they're doing a lot of work also, and it's the balance, and we're working on this today of we kind of have what's right in front of us and the things that we need to get done. But a lot of what we need to get done is also making sure everyone else is getting things done also. And how have, and I still have room to improve, and we all do. But like, I guess on the going from, because you didn't have any direct reports at your last employer.
I didn't have any direct reports, but I was the person that was kind of in charge. Like we kind of had a small department.
You were reaching out to property managers.
I was reaching out to property managers. I was in charge of training, like on our financial like variance report or whatever. And so I got to meet a lot of property managers and maintenance supervisors because I had put together that training and I was responsible for giving that training. I can't remember if it was like every other month or once a quarter or something like that. It's funny. There's actually a picture of me doing it like with my son Harlan, like in a baby carrier on it. Just because like I was the only person who could do that training at the time. And I was supposed to be my day off to keep an eye on him. But I was like, well, I've got to go give this training.
Get it done.
And so I did that. And then like there was another person, similar role in my department. And I had been there for a number of years, but that position had kind of cycled out a couple of times. So I was the person kind of in charge of training and bringing that person on.
Got it.
So I had done a little bit of that, but at that point, no like direct reports underneath me.
Well, so I'm just curious how that transition, how have you gotten up to speed and all of a sudden you've got a lot of people that are, reporting to you or you're working with
that's probably been one of the hardest parts of the job and the transition because I have been doing acquisitions. I have been doing like reporting and I've been doing all of that stuff for more than 10 years.
Yeah.
And
putting your head down, just getting the work done.
Yeah, I could do that, and I could do that all day long. But then managing other people and getting other people to get the things that I needed, I think one of the things of the company I was at previously, it was a very large organization. So like if I needed something from a property manager, it's like, okay, get that from the property. If I'm not getting it, it's real easy. Hey, like I didn't even really mess with RPMs or stuff like that a lot. It was like I went straight to like the VP because my monthly meeting was with the VP, and it's like you got to get on them to get it done. And a smaller organization, it's a lot harder to just like figure out how we're going to get those things done.
It is and it isn't because like on one hand there are fewer points of contact, so it's like one of us has to get it done. We have to get it done right here.
Yeah.
And a large organization, you just have like all these other resources. It's like you can go to this person or that person, and it's like probably somebody's job, or somebody will just maybe do
it. And I think that's what it's because of the size company we are. Like we were an affordable, so like we had a compliance department. Yeah. So like if we had something, it was like if there was an issue with compliance, it's not like the property manager needs to like figure out and like, hey, what do we do with compliance? It's like, no, you go to compliance. Or
and you're not going to the compliance guy who's doing all the compliance and you're bothering him. You're like, you go to the manager or the vice president or the director or whatever of the department. And you're like, hey, your job is to make sure all this is happening. Make it happen. Harder to do when we have departments.
And we're growing. I think we're developing some of those systems, but I think that was the hardest transitions. I came from a very structured company that had 20,000 units, had been around for 75 years, like had all of these deep SOPs and how you did things.
Yeah.
And it's one thing to know them and use them, but it's another thing, like, I think coming over here, it's like, oh, I know that that's how you do it. But like, if you haven't built that system underneath it for other people to know how to do it.
Yeah.
And then it's like, well, why didn't you do that? Well, I didn't know I was supposed to do that. But doesn't the property manager just always do that? Or doesn't the asset manager always do that? Not if they're not told.
No, if they're not told. It's so true. Well, okay. I want to jump right into the episode. I think it was a really good intro. And only people have heard that whole story. But let's jump in. We've got a piece of the jargon bin. I want to do a jargon bin segment. Ready to go?
Yeah, let's go.
Okay. So the jargon bin, if you are a regular listener or viewer of the Great Report, we take a topic, a piece of jargon in the multifamily industry and try to strip it down, make it a little bit more easy to understand. These are all terms that if you've been in multifamily for a while, if you're an investor, you probably know these terms pretty well, or you at least have heard of them, but oftentimes they're misunderstood, or we're not clear on the definitions. And so often people don't even raise their hand and say, I don't know the term. They'll just go on and just keep using it or hearing it. And so we're this is like a free pass for everyone listening and watching to be like, oh, yeah, I knew that. Or like, oh, now I'm glad I know that. Okay, so we're talking about DSCR, or the Debt service coverage ratio. Jay, not to put you on the spot, I'm going to start with the simple definition, and then I'm going to ask you some clarifying questions because, that's kind of why you're around here, is you can answer all these questions in a much more sophisticated way than I can. So, debt service coverage ratio, it measures whether a property generates enough income to generate its debt payment, or basically, it's got to be making enough money to pay the mortgage on a monthly basis. Do we have that right? Makes sense?
Yep, that makes sense.
I'm like, I think we've got it right. So a DSCR of 1 means that you can completely cover your mortgage payment, but nothing more. So if it's $100 to pay your monthly mortgage, and you make $100, all of that $100 goes to pay your debt service coverage ratio. It's a ratio of 1 to 1. No mas. See? Got it? Right? Okay. We have a bilingual podcast. Layer 2, slightly deeper. Okay, so getting to the math. Again, this is pretty straightforward, but the DSCR equals your net operating income, which is your income. NOI divided by your debt service. And debt service means your mortgage payment. Whatever, it's principal and interest, or just, maybe we'll get into that later. So an example, if you have a net operating income of $1 million, debt service payment or mortgage payment monthly of $800,000, you've got a DSCR of 1.25.
Correct.
Or 25% more income than you need to pay for your mortgage. Are we missing anything?
No, I think it's pretty simple when you just lay it out as to what it actually is. I think where the complexity comes is, why is it important and what is it measuring?
Why is it important?
So the biggest thing that's important is when we say DSCR, we care about it obviously from a margin of safety for our investors, but who really cares about it is the bank, who's giving us the mortgage, and they size it so that way they have the margin of safety. Because obviously we could go into the whole deep dive of why we use leverage versus just buying everything all cash and all that. But the banks also know that, and so in order to keep us honest for how aggressive we can get, there are kind of 2 levers that the lenders use. There are more, but there are 2 primary ones. Primary ones are loan to value, or LTV, and DSCR, debt service coverage ratio. The old kind of everything was like 75% LTV. And obviously there are layers to this, but it could be 75, 70, 65 for lots of different reasons. And then this DSCR ratio is how the agency, whether it's a bank, whether it's the Fannie Mae, Freddie Mac, whether it's HUD, they kind of have their own internal measure of how they do that. Like we said, it's the NOI divided by the annual debt service. Now, there are 2 parts of that annual debt service. There's an interest only, if your loan is interest only DSCR, and then there is a amortizing DSCR, which is the total amortizing debt payment. And so you can actually have 2 different DSCRs depending on whether it's an interest only or whether it's an amortizing.
Now, we did interest only recently as a jargon bin topic. So if you want to go back and watch that jargon bin episode, you can do that. But so let me ask you a question. This is getting into level 3, more advanced. But so you brought up interest only period and how your DSCR is different, because I guess if you're only paying your interest, you're not amortizing. It's less debt service in that year, which means you have a higher debt service coverage ratio. So how does the bank look at that? Because often you don't have interest only for the entire term of the loan.
It does depend, though, on how much interest only you have, and how far down the road that you have that interest only. Because, like, perfect example, Club Meridian that we own. Yeah. We have a 10-year term and 10 years of interest only on that. Mm-hmm. So we never have to worry about what an amortizing DSCR would look like.
It's not applicable. So you have to get a new loan before you start amortizing.
Exactly. So that factors in a little bit, but also in a situation like that, we had an LTV constraint on our loan that kept us, like, we couldn't have gotten an 85% or 80% or whatever LTV and gotten all of that interest only. So they weight the 2 of those slightly differently depending on how aggressive you're being.
And they don't want you to take out more debt, a higher mortgage, if you're not going to be paying any of it back.
Correct. Okay. Because then they're at higher risk for not being able to get their money back when you sell it, if you sell it into a down market. But if I'm only levering 65%, there's a pretty good chance they're getting their money back in 10 years, no matter what.
Yeah, makes sense.
Unless I've completely run it into the ground.
It had the value would have to, if it was a 60% loan to value, the value would have to drop 40% for the bank to take a loss and not grow at all over that whole period.
Exactly.
Yeah. So there's different DSCR, different lenders have different DSCR requirements. Again, I'm totally putting you on the spot. What are some examples? Who's more loose? Who's tighter?
So HUD, if you're looking at the actual DSCR ratio itself, HUD has the lowest DSCR ratio, and that's at 1.15. It used to be 1.178 and rounded up to 1.18.
Good enough for government work, I guess.
But that's the lowest. But a HUD loan is a fully amortizing loan. So you're going to have that DSCR on your amortizing balance day one.
Got it. So maybe a little bit skinnier in DSCR, but you're paying that mortgage back day one. So there's some margin for safety.
Exactly. Got it. So you have that. And they've been playing around with that a little bit. And
and it's because now Fannie and Freddie, there's a government guarantee as well, but the Ginnie Mae, and we're getting into the weeds, but like the Ginnie Mae loan, is that government, is that guarantee a stronger guarantee?
So you pay a mortgage insurance, you pay an MIP when you have a HUD loan, which is basically the insurance product the government uses to reinforce that.
Yeah.
That security.
But the MIP, that's because the leverage is high enough and the DSCR is lower, but that's different from the actual, like the government guarantee that the government provides.
So that's your mortgage insurance. And so
mortgage, exactly. MIP is your mortgage insurance.
Yeah. And so it's similar to like, if you were to go out and do like an FHA loan, like on your house.
If you got the 3.5%, whatever.
Yeah. And so it's that exact same like product on that kind of guarantees in it. It's the money I think the government uses to kind of back those products themselves.
Well, so HUD 1.15, maybe used to be 1.178. How about for Fannie, Freddie, the other agencies?
So Fannie and Freddie, I mean, the easy answer is 1.25. Yeah. If you're just taking rack pricing, as they like to call it, it's going to be 1.25. Then there are different things that could make that go up or down. They are less likely to go down now than what they have been in the past. But in the past, they've been trying to compete with HUD and with some of those others, and they've gone down to 1.2, 1.15 when everything was moving and everyone was trying to buy business. They've since stepped away from that a little bit. And now what's more likely to happen is if you're in a pre-review market, maybe you get at 1.3. If you're in student housing.
And what is a pre-review market for those who don't know?
A pre-review market is a market that the agencies have to basically submit a package to Fannie and Freddie in order to do a loan there.
So it's like, we don't know that place. You're gonna have to tell us about that place.
Exactly. And a lot of it is like kind of going down the rabbit hole here, but you have these DUS lenders, especially on the Fannie Mae side.
And what's a DUS lender?
Now you're putting me on the spot because I don't remember the
it's a direct underwriter and servicer.
Okay, I knew it was direct, but I couldn't.
You guys tell me if I'm wrong, but they underwrite their own deals and they service their own deals. And they are the originator. There's a difference between Fannie, if they're a DUS lender, is they're underwriting the deal. They're basically
taking the risk on their balance sheet.
They're taking the risk of their balance sheet. They're taking it most of the way, and then they bring it to Fannie kind of near the end. And Fannie's like, sounds good. You wrote it up unless it's really bad. Or Freddie, they're doing the initial underwriting, but then they send it over to Freddie to actually underwrite and say, this is what the terms that we're going to offer.
Yeah. And so then a pre-review on Fannie is basically going through that Freddie process where you have to send it to Fannie to get approval before you can get that back. And so those pre-review markets, they can come back and say, hey, this is a little bit too risky for us. It's too tertiary. We're too exposed in this market already. A handful of things and be like, hey, for our margin, we need to increase that DSCR to 1.3. And then student, this is one that we don't have to deal with because we're not student, but we have to be mindful of because we do operate in markets that have student. Yeah. There are thresholds for percentage of your tenant base that are student. And if you are over that, it's 40% right now. Then you get hit with 135 DSCR. Okay.
So if there's something related to the property, and for that example, it's student, or it's a heavy student population, they're equating more risk with that population, and so they're going to ask for a higher DSCR, or in a market they're less familiar with.
Correct.
And so they're like, we don't know where that is, and so we will lend on it.
Or they have been an area, because one of the pre-review markets, and talking with someone,
give us some examples of some markets that should not be pre-review markets that are pre-review markets.
I don't know if they still are, but for a while, Houston was one, because it was just so oversaturated. There were so many deals going on.
And is that big thing because just they're like, well, Houston's a complicated market and like it's patchy and we want to know more on the exact area? Because Houston's like one of the largest like MSAs in the country.
And I was surprised to learn that. I talked to one of our lenders and they're like, oh yeah, no, like there are, and I don't know if it's all of the Houston MSA or if it's specific markets, but they're like, yeah, like there are pre-review markets that we have to go into for Houston. And
wasn't Indiana,
Indianapolis, or all of Indiana was pre-review. And talking to our lender, Indianapolis itself is no longer pre-review, but I believe anywhere else in the state of Indiana outside of the Indy Metro.
See, this is what we're talking about. Everyone who's listening, they are so unfamiliar with the Midwest that they're like, no, pre-review. We need to figure out where it is and what it is before we can lend on it. I mean, I think it's wild.
And Indy not being pre-review is fairly recent in the last 2 to 3 years.
Ooh, okay. Early innings. Wow, that's wild. Okay. Well, anything else DSCR that we should know?
I mean, there are some other out there. Like if you go bank, if you go some of the other
tell us about non-agency.
There are people that will go out there for a 1.0.
Well, yes. Let me ask you this. So let's say I'm a developer.
Yep.
I don't have any income. What do you do with the DSCR then?
So now you're getting development. These are ones I am not as familiar with.
Yeah, that's not what we do.
And so,
lend on pro forma. It's like it's a loan to cost loan. Typically, is a balance sheet, full recourse.
Appraisal is a big one on development. Just a little bit I do know, and so DSCR doesn't as much matter on that. The biggest thing so I'm not speaking on stuff I don't know on development. Where I do know is the biggest, like that 1.0 is heavily on lease up deals that are sold out of developers, where they can do a forward looking pro forma at a 1.0 that you then grow into your 1.2, 1.25, something like that. Okay. But in order to get where you need to, you have to have some money set aside and some escrows to kind of ensure that you're going to grow past that 1.0.
Got it. Okay. Jay, that was really great. Again, DSCR, it's a critical part of the deal, and most reviewers are going to be very familiar, but some probably have not heard that discussion like that. And I remember going for a long time hearing, DUS, or is it dust, and not knowing what it is, but being like, yeah, I understand that's a type of lender. And so I think, again, these conversations are trying to remove the barrier of entry, which is just like jargon and insider speak, which the financial industry has just layered on to gatekeep folks from participating because you don't know the special words that we made up. And we're trying to just debunk or not debunk, but we're trying to shine some light on some of these special words and terms and try to demystify a little bit. So I want to move on to the next segment of the Gray Report, and that is the Matrix corner, or I don't know, it's Matrix Tuesday on the Gray Report because we have two different Matrix reports. One from Arbor Realty Trust. They have a return matrix of some of what they're saying the best markets right now in multifamily in 2026. Then we also have the Yardi Multifamily Matrix report for March, which we look at the Yardi report all the time. And because I had the Claude browser open in the podcast room, I made a Gray Report Matrix background for us to look at. So it's got multifamily terms that are dropping in. We're dropping right into the matrix. And I'm going to try to not talk about AI for the rest of the episode, except Yardi Matrix brings up AI and the war. I was like, I'm going to not talk about the war in Iran. I'm not going to talk about AI. We're going to talk about multifamily. They're too it's all interrelated. So let's talk about this Arbor Realty report, top markets for multifamily investment. The report for spring 2026. Key findings, and again, this is not the only reason why we're looking at the report, but wow, Indianapolis ranked first in Arbor's spring 2026 opportunity matrix, supported by strong labor market conditions, tight occupancy levels, and a favorable affordability profile. It's saying Midwestern markets, which feature stability, affordability, steady renter demand, were well represented capturing 7 of the top 20 spots. You know, not that it surprised me because, we love Indy, but things generally, the market has been slow. And you mentioned, Jay, earlier on in the episode before we press play that, Indianapolis it's a steady Eddie market. And sometimes being steady and positive is way better than being kind of hot one moment and then being largely negative the next, and maybe for several periods after that. And so it's kind of the same old story of the tortoise and the hare, and the tortoise is winning once again. Curious your thoughts. Are you surprised to see Indy take the top spot, or?
I am initially surprised to see it, or I guess I'm trying to maybe shocked to see it, but not surprised when I kind of like peel back a layer deep. And I think the best thing I can do to equate this is I look at our own portfolio, and it's like, okay, we all know, like, we have some great deals. We have some deals that are doing just fine. We have some deals that aren't doing what we want them to do. We have everybody who owns any property has that old 80-20 rule going on. But ours has been manageable.
Yeah.
And it's stuff that we want to work on. And there are things that are like, hey, for the best service of our investors, we got to get this right, and we've got to do this. But I know for a fact that we are not dealing with some of the stuff that other people in other markets around the country are. Yeah. We are not in Austin dealing with 60% occupancy on a lease up. We are not in Atlanta where we can't evict residents and people are sitting in units for over a year not paying. We aren't dealing with some of those other things that maybe we aren't crushing it on this deal, or maybe we are on this deal, but I think our portfolio has kind of just shown that we are making incremental improvements, and we are seeing that. I mean, we had one where we had some occupancy issues end of last year, and like I talked to you about this morning with our asset management stuff. On paper, is it where we want it to be? No. But I can tell you that every single week they have made progress. It's not like, hey, we got 10 leases this week, and then we evicted 15 people. No, they've grown their occupancy 1% to 2% each week. They're going the right direction. And oh, by the way, their bad debt is a third of what it was last year. So even though occupancy isn't where it wants to be, our economic is rounding out to where we're not hurting as bad as we thought we would.
Yeah.
And so I think that when I see this, I think of our portfolio and I see like, hey, yeah, like we have some stuff we'd like to get better. We'd like to flip a switch and it'd be better tomorrow. But we own in Indianapolis. Like we have about 2,500 units that we've got that's in our portfolio. 1,000 of those are here in Indianapolis. And I look at everything from our Class B stuff to our Class A stuff and everything in between. And that's what I see is it's just kind of this steady, keep moving it forward. I mean, we have one property I know that's in probably one of the most competitive submarkets in the city. But we just are kind of in this little pocket where it's like, hey, we're not going to ever have the highest rents in that submarket, but we're getting constant traffic. We're signing leases. Yep. Is it doing everything we want it to? No, but I can see the path of where it needs to go, and it's the real easy. Take it one step at a time.
Yeah. No, I think the Midwest being, you put very like manageable, like some of the challenges, and if given that like this is like the kind of the trough of the market, it's like, well, we can manage this. I think it's a good position to be in. Whereas, and part of that is how we structure the deals, because we could be in the right market, things kind of just moving not as quick as we wanted to for some deals, but if we finance them the right way and we set up the deal the right way, it's kind of, we have runway because that's how we designed it. We designed it saying like, all right, we may run into some problems, may run into a recession or inflation or whatever, and we can get to the other side of it. Whereas if we're like, no, this is all going to be short-term bridge debt, we're just going to move on to the next thing. We could have bought the same assets for the same price, but have been in a much different situation.
100%.
Any other markets on this list? So that we're looking at the Arbor Chandon Spring 2026 Opportunity Matrix composite scores. The average market score is a 0. Then Indianapolis is a 0.35. The next market is Raleigh at a 0.33. Then Salt Lake City 0.31. Then Nashville 0.29. Then Milwaukee, San Jose, Charlotte, Chicago, Richmond, Phoenix, Seattle, Denver, Columbus, Atlanta, Cincinnati. Any of these stand out to you from just an opportunity? Because that's what this is, and we can get into the methodology of how they're making an opportunity composite score. This is kind of similar to what we were doing with John, but on just a full market, not zip code.
I think
much more granular.
I think that one thing, I think there are some things that I see as obvious opportunities. We're going to look at here and we're going to see the Midwest stuff. Milwaukee, Chicago, although Chicago maybe not exactly for us. We've talked about always wanting to. But then Columbus, Cincinnati, Pittsburgh, Kansas City, those are all markets that we underwrite, we look at, and we see the opportunity. And there are some on there that surprise me from an opportunity standpoint because I've just heard so much bad about those. And I think the two that stand out to me right off the cuff are Nashville and Phoenix. I mean, because we talk about supply, we talk about all of those other things in those markets. And so those two markets where I've heard so much about supply risk and being overbuilt, I'm surprised that this is saying that there's opportunity there.
Yeah, I agree. Now, there's a lot of demand in those markets also. So that certainly has to be, that's the other side of the coin. Looking at the opposite side where there's not as much opportunity, some extremes here, and some of these surprise me also. Grand Rapids, the one that jumps out to me is that's usually we see as some opportunity in Grand Rapids. It's a market that we're not in, but we've looked at getting into. And I think
correlated with that, the one that I'm surprised to, coincidentally, is Detroit.
I agree because there typically has been a lot of opportunity and job growth in Detroit.
And I know that Detroit kind of has a reputation, but if you look at the numbers, I mean, we've looked pretty heavily and come pretty close on some deals in the Detroit metro area.
That's what provides the opportunity.
And so we've looked at some deals there, and there have been some really strong opportunities there. And so that's one where, because of the repositioning of Detroit and the diversification of the manufacturing and some of the growth in some of those like suburban markets of Detroit, I'm a little surprised that it's saying that there isn't opportunity there right now, or less of an opportunity there right now.
Yeah, I agree. Also, what else was what I was looking at? St. Louis and Austin are right next to each other. I mean, Austin maybe is not as much of an opportunity. And some of this, I guess, is like relative to how we're going to look at the Yardi Matrix report and have the rent growth in some of those markets and the job growth. But like New York on here is at negative 0.15. And that's just about neutral. But New York, I mean, according to the Yardi Matrix report, has seen incredible year-over-year rent growth.
And I think the thing that surprises me the most is when I think of opportunity, I think of those markets that have been suppressed for so many years. And I mean,
like
Chicago,
San Francisco Chicago.
What I use on here, because Chicago is showing good opportunity on this. And I would think that in markets that have been kind of beaten down the last 5 to 7 years, like a San Francisco, I mean, and
San Francisco has had some of the highest rent growth along with Chicago. But San Francisco's down here at negative 0.04. I'm just about neutral. But yeah, it's interesting. I mean, obviously, they're pointing out the Midwest stability. It's interesting. I'd like to learn more about the methodology behind this. I know a lot of it's driven by labor, the labor market and supply. Here's their absorption subindex. I mean, this is where Jay, we were talking about Nashville. They do have a lot of supply, but I mean, they are absorbing it. More right now. They've got positive absorption. This is 1.09. It's pretty good compared to the top 50 median at 0.13. Looking at this chart, I thought some of these. This is kind of what's driving it. Indianapolis, looking at pretty good wage growth. Wages are growing by about a little over 5%, but the unemployment rate is sub 4, and so I think the higher and to the left, the better. I think Virginia Beach out here has got some crazy wage growth, and their unemployment rate is pretty low also. So definitely a market. Atlanta isn't that bad either. I mean, again, you can't just look at these two different metrics because someone can be making all the money they want, but if they don't pay and they don't leave, it's gonna be a problem. Although I think a lot of the backlog in Atlanta has been figured out.
It's all now finally moving in the right direction, but I knowing some owners who own in Atlanta, we've definitely heard some horror stories.
That's true. Now, chart number 5 here, this is the Zillow Observed Renter Demand Index. We thought this was interesting because of just, how red the Sun Belt is, which is counter to the narrative of like, hey, no, there's still all this demand in the Sun Belt. And there is demand, but the Zillow Observed Renter Demand, it is like right across the board. I mean, I think Atlanta is the only market here on this list that is kind of green. I mean, the North Carolina, Raleigh, Durham is green. I think, in Oklahoma, there's a little bit of a green mark. And then it's all, on the coasts, California, the East Coast, and then, the Midwest, these are all our markets. So it's, we are in a period of transition. What does this map look like in the next couple of years?
I think the ones that are in high demand right now, I don't think that changes because those are metros where you can't afford to buy. Like you're not buying a house in New York City.
Do you think people are going to stay there because of the affordability though? I guess it hasn't stopped them.
But if you're going to be there, you're going to be a renter. And so, so I don't think that changes. What would be real interesting to see is kind of the mid demand versus low demand and how that changes, because here I think we've seen kind of an inversion. I mean, for a long time, I don't know how many times it was told to me growing up, like it's cheaper to buy than rent.
Yeah.
And like, that was just ingrained.
You're throwing money away.
And I think that was a big like thought in Indiana for a long time because costs were just so low.
Yeah.
That's not necessarily the case right now. And so right now that cost of building, that cost of owning a home, all of those things haven't gone back to what we grew up knowing.
Let me ask you about that. So cost to own a home, affordability. So in the Midwest, it's cheaper to buy a house. It's actually affordable. You can do it.
Yes.
And so one might think that it's not a good place to invest in rentals, but it seems like housing demand is housing demand. If you're getting people to buy homes, it's also affordable to rent in those markets. And when people buy homes, those are like economic activity. And so when people are buying homes, you need people to like fix up the homes, you need people to build more homes and service the homes and go to furnish the homes and hire the people to, mow the lawn or whatever. So it's positive. It's positive for the economy. And then still some people aren't going to be able to afford to buy a home. They don't have the down payment. And so sometimes I feel like it's, is it going to hurt the Midwest because we're so affordable, or just because we're so affordable and people are going to come whether they're a renter or a buyer?
I think it's, I hate the cop out that it's a little bit of both, but I think back to my hometown.
Yeah.
I am from Lafayette, Indiana. So I'm from about an hour northwest of Indianapolis. For those listening that aren't familiar, it's where Purdue University is. And so when I was growing up, so I was born in 1987. And I know from doing research, I know a bunch of apartments and I know a bunch of growth and development happened kind of in the 80s.
Yep.
And then not a lot happened if it wasn't associated with the university until the mid 2000s there.
Yeah. And part of that was like savings and loan crisis and just the way the apartments were kind of financed and invested kind of changed in the late 80s.
Exactly. 90s. And so there just wasn't this thing. And so like when I think about it, like I could tell you every neighborhood of housing that was developed when I was growing up. Like I could point and be like, I joke, and I think I've told you this before, there's this road that is on the south side of Lafayette. It was County Road 350 when I was a little kid, and my grandfather owned a paving company. And I remember they took that from a gravel road to a 2-lane paved road. And when they did that, they were offered like the chance to buy all of that land, like pennies on the dollar.
Yeah.
And at the time, they're like, we're not land guys. We don't know what to do. Like, we just turn these are cornfields. Like, we're going to do this. Fast forward 10 years later, that has been completely developed, is 10 new subdivisions, a new Walmart, a strip center for restaurants, banks, everything. It's exploded. There's like 3 giant churches anchoring each side of town. And so all of a sudden, it's like, that's where the growth happened. And I think that was like, when I talk about apartments being built, like the one apartment complex built on that road was like the first one I remember being built in Lafayette in like 2008.
Yeah, I don't remember. Again, I wasn't paying attention, but I don't remember like apartments being built when I was growing. They were. I mean, I wasn't paying attention to any of that stuff. It's certainly not like it is the last couple of years.
Yeah, and like I saw it, but it was all at Purdue. Like student housing or like tearing down dorms or something like that. Like I saw a little bit of it, but it was all over at the university.
Yeah.
Nothing where everyone else lived.
Yeah.
And so that's where I think we're kind of at this point where maybe we are more affordable, but just because we are more affordable doesn't mean that it can be afforded yet. And when it comes to your question about renting versus buying.
Yeah, it's a more affordable doesn't mean that you can afford it right away. You still might need, you still might need $20,000, $50,000 for a down payment, or maybe a couple $1,000s. Most people don't have enough. Most people don't have an extra $1,000 or $2,000.
I was going to say, think about even on apartments. It used to be. I remember when it was 2 months rent for a deposit.
Yeah,
no one charges 2 months rent.
Yeah, because people don't have the money. Yeah, which is again, it's not. It's a lot about society and how we're structuring ourselves. But I think it's interesting. I mean, I think this is really hits on what we're talking about. And when you have someone that is looking at a younger person who isn't tied down necessarily, and they're looking at all their options, when it's basically 2 to 2.5 times more expensive to live in some of these coastal markets versus the, call it inland markets, I guess. You really start to have to wonder about what you value and just what your options even are, especially when you're going to typically be able to make more money working in a San Diego or a Boston versus a San Antonio or a Louisville, but the arbitrage is still real. And then all of a sudden you bring in the potential work from home arbitrage, which is becoming maybe less than of an opportunity. But you can have, we see it all the time here in Indy. People move from California or New York, but more often they're coming from the Bay Area and they're moving to Indy. Sometimes it's because maybe they're from here, or maybe like they're relocated here and they're selling their $2.5 million like super small, tin sardine can townhome condo in the Bay Area, and they come to Indy and they end up buying like a $2.5 to $3 million like
house on the lake.
Yeah, huge house on like the nicest house you can buy in the area. I mean, like you can buy a $10 million house in central Indiana, but like there aren't that many that are like available.
I would say
they exist, but like it's usually like if you're spending more than a couple $1 million in a house, you've got that's like an insane house.
Compound.
It is a compound. Yeah, you're on 5-10 acres at that point, if not like wow, show me what that looks like. Your money just goes further. And as I think the demographics shift, like the millennials are having kids and all this stuff, I think people are thinking about their lives, and they're like saying, do I need to be in Boston? I mean, like I get it personally of like wanting to be next to like the ocean, or you want to be in the mountains or something like that. Or like in New York, if like you're a New Yorker, you always want to be in New York. You got to live in the city. Some people are like that. Maybe some people are like that for Boston. I mean, San Diego, it's like the weather's so good, but like you have to weigh all these, like the weather's nice, which you can equate to your mental health, I guess, and your well-being, and like what do you want to? You want to be in a nice place every day, and certainly in the depths of winter in the Midwest.
There are days we question it.
There are days where we certainly question it. But then you have like weeks like this when it is like absolutely beautiful and it's like high mid 70s and like just everything's coming to life, and you appreciate it so much that like, no, it's actually not that bad here. And the amount of money you can save, you can do a lot. You can go to some really pretty cool places. I digress. But man, this is just a stark contrast between some of these, again, middle America and the coast. And again, there's no right or wrong answer. If you want to live in San Jose and do whatever you're doing in San Jose, and I guess you can go to like Yosemite's not far. I don't know what you're doing, but you do you. And I'm happy for you. I keep going in Indianapolis, and we're going to switch over to the Yardi Matrix report. But long story short, Indianapolis has been outperforming the national average from rent growth for 30 consecutive months. Slow and steady, it wins the race. Typically, we're not always, crushing the national average. But that's a trend. And that's where I think some of the questions that I have, and I feel like I talk about Indy in the Midwest all the time. So maybe this is going to sound strange coming from me, but like the the rotation into the Midwest from renters, seeing the affordability advantages, and then also investors rotating from the Sun Belt and elsewhere, or investors rotating out of office and other commercial real estate asset classes, or wealth managers rotating out of public equities into alternatives because their clients, need exposure to real estate and in alternative investments in the private markets. That starts looking like a recipe of like a three banger of inputs that could really start getting things accelerating in the Midwest. That it's hard to underwrite, and it's kind of like it's on the board, but 1 year, 5 year, 10 years, you don't know.
And I think that's the hardest thing, because one thing that we keep kind of coming back to is like jobs. Like, where are the jobs going to be? And I mean, jobs in manufacturing. Like, I mean, I think that's the thing with Indiana. Indiana is one of the top, if not the top, like manufacturing per capita in the country.
Yep.
And so I do think that in this, like, Indiana, I think one of the things that it has done really well, and kind of going back to where I grew up in Lafayette, I think Lafayette is a good kind of benchmark for the state of Indiana, because when I was growing up was kind of the time where all those manufacturing cities were dying. Like, if you hear about Kokomo, Marion, Muncie, like those all collapsed because they were all on like one factory.
Yeah.
Lafayette was different because Lafayette had SIA, it had Purdue University, it had Great Lake Chemical, it had Alcoa, State. Now this is manufacturing, but it had like State Farm, and so it had kind of 5 or 6 large Wabash National Trucking. Like, it had these multiple large kind of diversifications where Lafayette didn't see the huge decay that almost every similar sized city in Indiana felt in the late 80s, early 90s, kind of when I was growing up. And so like I heard about all that going on. I'm like, well, we have manufacturing. Why aren't we? And I remember my parents telling me it's, well, the mayor of Lafayette, when they were doing all of these like deals with all of these people in the 70s and 80s, he was like, we are going to have different options, because he's like, our entire city cannot work for one company.
Well, it's smart. And the Midwestern markets that have recovered and found a way are those that diversified. And some are still, I mean, Indy still has a ton of manufacturing, but we diversified, lead into healthcare, bioscience.
And what was it? Up in Warsaw has like all of the biomedical. Obviously, Indianapolis, kind of with FedEx and all that, is kind of huge on logistics, but still has those kind of manufacturing on the outskirts. Obviously, Evansville, we see the car industry down in Evansville very heavily. They've repurposed, like up in Elkhart, it used to be manufactured homes. Well, they still do that, but now it's component manufacturing. And so I think the state has done a good job diversifying those manufacturing jobs. I mean, you look in Lafayette.
Columbus, Ohio, just to go outside of Indiana. I mean, Columbus is incredibly diversified. The Fortune 500 headquarters, also manufacturing, but financial services, the JP Morgan, defense contractors, et cetera.
And I think that's probably a good like city. Like, I'm talking say with Indiana, but I think that's a good city. That's like you said, when you have, like you said, who knows if Intel ever happens over there, but like obviously Anduril, you've got the JP Morgan there on the north side. You've got Fortune 500 companies that are based out there.
Abercrombie,
and so those are companies that have grown there, and I don't see those companies going away tomorrow. And so if those
even if one does, that's the whole point, right? It's you're kind of fine.
And so I think those kind of markets are the ones that are going to see growth in the future. Are they going to be 20x markets? No, but they're not going away, and they're going to be that nice steady return when people are chasing ups and downs other places.
Let's keep going on our matrix journey. Let's get on the Yardi matrix because we've got some reports from March 2026. And the reason why this is so important, why we need to jump in, is because we are in the middle of spring leasing season, peak leasing season. It's now. Again, it used to start a little bit later, call it maybe May. Last year, it started in March. Now, one question we had going into this year was, is it going to be the same thing? Has it shifted earlier? Did COVID kind of throw things off? Are we still getting back on these strange lease expiration schedules? Right now, I would say we're not seeing the growth that we really would want to see in March. Now, we are kind of holding our breath for April's numbers to finish out.
I would say March
what do you
March
think?
was fits and stops, and a lot of that was weather.
Do you think, though, people were like, it's fits and stops, it was more positive than it had been, but like we wanted it to be much more positive than it had been?
I would agree with that. And I think what happens, like the one that sticks out in my mind, I look at Villas on Fur up in South Bend. And that's one where it's like, it's lake effect snow. The pictures I've seen of the snow removal we had to do there are incredible. But so like for them, they still get 1 to 2 leases a week. But it's not surprising that when there's a foot of snow outside, people aren't driving next door and trying to move apartments. But so then all of a sudden we had weather break, and there was a week we got like 7 leases, and it's like, oh well, the weather broke. We're gonna go.
It pushed forward the demand, and then it got picked up. So those people still needed a place to live. Like, we're not going to go look this week.
And then like the next week was another snowstorm.
Yeah.
And so I think like that one specifically, I can definitely see like the patterns of like the traffic versus the weather. Now that we're in April and we're out of that a little bit, I do think that like we kind of had this big like ramp up March into April before we saw drop off last year. I do think it's been a little bit more measured this year. I don't think it's been quite as like.
What do you think because we often think in 12-month leases. Tell me about the impact of revenue management systems that can optimize the lease. And one of the tools that it uses is having some variability on the lease term. So it might suggest a 9-month lease or a 7-month lease or a 14-month lease. And so like in my mind, last March, signed a bunch of leases, they should turn over in March. But maybe that's not the case.
I think for us it is, because last year in March, like we weren't on like.
Yeah, but think about the whole industry.
It happens. And I think from our standpoint, we think about like, hey, let's optimize this. But if I think about it from a renter's standpoint, unless I'm on like a contract, like, hey, I know I'm going to be here for 3 to 6 months.
Why would you want anything other than shorter?
Why wouldn't you want a year? Like, I don't want to pack all my stuff up and anything less than a year unless I have to.
But they could go later. They could go longer. Maybe that's going to be more expensive, I guess.
It could be more expensive. Maybe you don't know what the next year is. Like we see people moving jobs that it's like, well, maybe I may not have this job in a year. And so I think if someone's renting, obviously there's kind of 2 renters. There's a renter by necessity, renter by choice. The renter by choice is going to want optimum flexibility. So they may not want to move in the next year, but they want the ability to move if they want to.
So they want flexibility, but they also want stability. And I guess my gut is that there would be some desirable to like kind of lock in and like not have to move every year and be like, hey, I'll sign up for not a 24-month lease, but an 18-month lease.
And I think could they? Yes. I wonder how many people.
How many 18-month leases are we signing? Very few.
Almost none. The place we've had the most success is one of our properties has some very high legacy residents in it. And that one, what we did is we offered 12-month leases, but we did like a guaranteed increase on year 2, where they just kind of knew that it was going to be a 3% increase on year 2. And that's probably been the most successful longer term lease that we've done in our portfolio.
Do you think we push it? And this is all live. Do you think we push longer leases enough? I know like we've got AIRM and stuff that can do it for us, but like, do we ever? We're just curious, especially I guess in an environment today where we want to be a little bit more defensive.
I think in an area where we want to be defensive, it makes more sense. I think our SVP of property management, Katrina's argument to you would be, the longer we lock that in, the less chance we have to push that on the back end. Because let's say that the world is completely different and we're running gangbusters in 9 months. Yeah. But we just locked everyone into these 18 to 24 month leases, and now we lose an entire year of being able to capture that.
I think it's a fair point. I guess what I would say is let's not sign every lease at an 18-month. I'm just saying, can you sign some? And it's like that staggered out a little bit. And so you're hedging a little bit of, you don't have as many lease expirations, because also, you may not have the opportunity to bump rents more, but how often are we, how much are we bumping rents today? Some properties we are, some properties we aren't. But then it's expensive to turn a unit. So like, do you want to be cutting the cost to turn a unit? Do you want to do it every 12 months? Do you want to do it every 18 months?
There's
so
an
it's a
both.
net, it's like, so what are you gaining on the new lease versus what are you spending to get that new unit ready? And it all depends on the property and the market.
There are some properties I could make the argument that we should. I mean, up
if
in
you're
Lansing,
spending a lot of money.
Up in Lansing, we've seen great trade outs on that one. Down in Evansville, I think that you're right. Like, locking that up for 18 months probably makes a lot of sense.
Yeah. Let's jump right into the Matrix report. Otherwise, we just will talk our book all day long. But multifamily rents, this is from the Matrix report. Multifamily rents rose in March for the first time since last summer, but the growth was modest, and most of the Matrix top 30 metros remained negative year over year. The average U.S. advertised rent increased $5 to $1,750 in March, with year-over-year rent growth holding at 0.1%. Now, advertised rents increased $4, up 0.2% during Q1 2026, a positive but weaker than normal first quarter performance. Operators in many markets report spotty demand in recent months, and national occupancy rate for stabilized properties is down 40 basis points year over year. Going to looking at, again, just this little chart of rent growth. I mean, again, we've just been kind of vacillating and oscillating, and we haven't really made any progress since 2025. I mean, basically, we're kind of the same rent levels we were back in July of 2024. Looking at the charts, you see, again, this is where, according, just comparing to the Arbor report, seeing New York City as not being a big opportunity, and we're not investing in New York, so we don't have a dog in this fight. But New York City, according to the RD Matrix, on year-over-year rent growth, is in the top spot for all asset classes and renters by necessity. For the renters by necessity, man, rent growth is working really well in New York City, Jay. New York City, rents are growing almost 10%. Wow, thank you. Wow, rent growth is really effective in New York City. Let's pick another market that has a lot of rent growth, and a state that has a lot of rent growth. It's San Francisco in California, also coming in the top spot of year-over-year rent growth. It's almost like if you restrict market rents, you're going to see rents go up. Oh my gosh. It's hilarious, except it's sad. But Arbor had New York and San Francisco not near the top. Maybe, again, you can't compound 10% rent growth every single year. Maybe Zoran Mamdani is going to clamp down on rents. Clearly hasn't happened yet.
I think what's funny about that is that's the renter by necessity. That's not even the lifestyle renter by choice. That's the renter by necessity.
Yeah. It's rich, or not. Anything on this list, Jay, that stands out to you? Again, we talked about coastal markets. We still have the Midwest on a handful of spots.
Well, and that's what I was going to say, because look at Detroit. We talked about this on the last report. Look at where Detroit lines up. I mean, obviously the two mainstay bell cows kind of for the Midwest, the easy answers are always going to be Indianapolis and Columbus. Those two have shown time and time again that they're just being resilient when it comes to that kind of steady rent growth. And I think we've talked about it a lot, the diversification of the markets, the labor force, and all of those things help those markets. But then you have like a Detroit where they're, from a rent standpoint, there's opportunity. Now, are there other factors that
maybe it's unemployment, maybe it is wage growth that is somewhat stagnant in that market.
But those ones specifically, and then obviously I would kind of say the trio of those, Indianapolis, Columbus, the other one being Kansas City. Of like those are kind of the three. Like Chicago is always going to be like Chicago. It is the Class A city in the Midwest, but it's kind of its own animal.
So you think if you're going to the top three Midwest markets for like quasi-institutionals you're going to get, excluding Chicago, maybe Indy, Columbus, and Kansas City?
I think those are the benchmarks. If we're saying institutional level of investment, I think obviously garners a lot of interest because I think they are the benchmark that everything is held up
those
against.
I feel like the easiest markets to underwrite, and they're kind of straightforward. Anyone can do a top level analysis and make sense of them. And then there's like the second tier is
Louisville, Milwaukee,
Cincinnati, Milwaukee, St. Louis,
Detroit, Grand Rapids.
Yeah.
I say there. The one that I don't know how to quantify.
Cleveland?
No.
What?
Minneapolis.
Oh, well, yeah. Oh, gosh.
So
yeah.
Midwest city, but I just don't know how to quantify it because it's not Chicago, but it also doesn't have any of kind of the markers of any of those other cities. And it is so far north. It's like it's an afterthought because it's so far north and like we think we have bad weather. They have even worse, but it's tunnels, large city, lots of Fortune 500 companies. But then there's also a whole other social dynamic going on there that affect how people view that as well. And so that's one market where from like a numbers standpoint, people there and jobs, that one should be easily number 2 behind Chicago.
Well, Minneapolis was a market that many economists at NMHC listed as their top investment market for this year and going forward, which is, again, from and again, this is, I think, a reminder, don't always maybe get so wrapped up in the transient stuff that's going on in the world, because this is like when the ICE protests were going on. Like those aren't going on anymore. Now you could say those are symptoms of a political environment that makes it challenging to invest. But you talk to people who are from Minneapolis that are investing in Minneapolis, and you have to know how to navigate things, but it doesn't make it absolutely uninvestable. There are more uninvestable markets than Minneapolis.
It's definitely not uninvestable, but that's why I put the caveat. And I think that's why I'm saying maybe not the best markets, but the easy benchmark markets, I think are Kansas City, Indianapolis.
What do you think
Columbus.
of Cleveland?
It's not a benchmark. Now, do I think there are opportunities there? I mean, Addison and I have looked at deals there. There's definitely opportunities there. There are pockets. Like I know people from Cleveland, and like there is a reason it exists. Like it's on the waterways, like similar to Chicago, Detroit. Like it was put there for a reason. Has it hit some tough times? Absolutely.
Yeah.
But there's just, I would say, too much uncertainty. Kind of maybe like a Detroit, where there's some growth, there's some opportunity, but you can't benchmark anything against that.
Yeah. All right, we're going to look at real quick because I've got a call I've got to hop off on, unfortunately, here in 2 minutes. So Austin, month over month rent growth, Austin is number 2 spot, okay, month over month for all asset classes. So, and it's number 4 in lifestyle asset classes, and it's number, I don't know, 7 or whatever, in the month over month renters by necessity asset class. I'm not saying that Austin is back, but we've said it's a matter of time. They've had so much supply. Again, they are at the bottom of the list for year-over-year rent growth, but there's some light at the end of the tunnel for Austin. Surprise you, Jay, or what's
that one doesn't surprise me because just knowing
it's a matter
people
of time.
We've talked to, it's a matter of time. We've talked to enough people that are like, there are some opportunities coming in Austin, and so.
Well, and how low can the rents go? The rents were so low in Austin. I mean, they've been lower. They've been dropping by like 8% year over year over year. So at some point, you got to grow from somewhere. So, they say the cure for high prices is high prices, and the cure for low prices is low prices. And I think Austin finally found its cure. And so maybe there are some folks that are going to actually be able to underwrite rent growth in Austin. Look at that. Jay, thank you for coming on the Gray Report. You're going to have to come on more. Always invited. And we've got some exciting stuff going down the pike. We've got a deal almost under contract. We even talk about it. It's so exciting. We're going to see previews. Jay's going to be on talking about it more. Griffin's going to be here back in the seat for next week's episode. I got to hop on this other call. We got to talk to investors. We got a deal to do. Jay, thanks again.
Thank you for having me.
Make sure you subscribe to the Gray Capital YouTube channel. You like this video, and I don't know, there's a bell icon, press it. But leave a comment and tell us to have Jay come back on. Any other questions and any thoughts for the jargon bin? We'll answer your questions. See you on the next episode.